Good morning, everybody. Thanks for joining us for the 16 success strategies. In today's discussion, we're going to be covering some purchase options and we're going to cover MCC credits and construction loans. So we've got a half an hour. I am going to try and respect your time as much as possible. So I've got some pre-built reports that I want to show you how I put them together and what they end up looking like when you get them out to the browser-based version. So to begin with, let's talk about the MCC credit. So on this one, I have actually just created a report. I've called it purchase options. And you can see that as I go through, I've got things like purchase a new home checked, and that's because I don't want to be asked about a current mortgage. I have my sales price here because this field is actually in red, so that one is required. If you don't enter it, you're going to end up with an exclamation point down here in the assumptions area. And if you do enter it, what happens is it automatically carries over to your new products as you're creating them. Now, the only part I filled in the affordability section here, and this is actually kind of important for doing MCC credits, is I made sure to put a tax bracket. You must have a tax bracket entered if you're going to show the mortgage credit certificate. Now, for those of you who are not aware of what an MCC credit is, this is a mortgage credit certificate that allows you to actually get a credit for a certain chunk of interest every year up to a cap. And this is not like the regular interest deduction that they would take. Rather, this is a credit. So functions a little bit differently, but we end up totaling everything in the tax benefit line for you. Now, when you want to use the MCC tax credit, as I said, you've got to make sure and put a tax bracket in there. Now, generally, I like to assume 25 or 28 for my tax bracket, specifically because I don't have a borrower in mind on this. However, if you have a specific borrower and you know their income and filing status, you can actually go find their tax bracket by hitting Find Tax Bracket. This is going to open up a new page for you that allows you to just basically look at a couple of variables and isolate exactly what their bracket is. John's question, real quick before we move on, he says, what if your client does not own a home currently? Do you just put their rent in? So actually, this is a perfect situation for it. What I did is I checked own, but when I went to the goals section, I checked purchase a new home. So it's not going to ask me about a current mortgage, and it won't actually say they own a property anywhere on the presentation. This just allows me to avoid the rent versus own. So what I did is I just selected own, and then in the second screen, I selected purchase a new home. So back to our affordability section, I've entered my tax bracket for my client. Now, the next step here is I need to make sure and enter tax credits. So I'm going to click on tax credits, and you can see that I've got this filled out. Um, I'm saying that they can write or they can credit up to 20% annually, and the cap on that is $2,000. So this is 20% of the interest for the first year, and actually it's each subsequent year until they decide to refinance or sell the property. They can still take this credit. Now, the maximum credit they can get in this case is $2,000. So if the 20% of the interest per year exceeds $2,000, it's going to cap it at 2,000. Now, in order to find out what these variables are, you'd want to look it up for your state. It actually is state specific. And the easiest way to do it is just Google your state and MCC. And there's going to be guidelines all over the place for them, specifically here in California. And in fact, sometimes it's even county specific. You can get in certain counties 20%, in other counties 30%. So check on your area, find out exactly what you can credit against. And of course, find out if your lender can support the MCC tax credit as well. Now, once you've got the variables for the tax credit in there, it's time to go over to the products. So what I've done here, as you can see, I've got 4 products. The first 2 products are with the MCC credit. So what I'm showing is a 10% down with MI, a 10% no MI, and then the first two options do have the MCC credit applied. Now the last 2 options are the same thing. They're 10% with MI, 10% without MI, but no MCC tax credit. And the reason I'm doing it this way is I want you guys to see what the difference is in the benefit. So for my first product, we've got a 10% down with MI and the MCC credit. You can see I've got my 10% entered here. I have the rate of return I can get them right now and the term. And as long as you've got those variables that we discussed back in the affordability section, those being the tax bracket and the tax credit area filled out, you'll see a checkbox here that allows you to apply the MCC tax credit. And you can do this per loan. So that's how I'm showing some of them with and some of them without. Now, the closing costs, I actually just went through these and pulled down one of my templates. But if you're not familiar with the new reserves category, I am going to show you that real quick. You can see I do have reserves in here and they're grayed out. And the reason for this is I'm using the new reserves field. So it's automatically calculating these. Now, where those are coming from is the next screen. So you can see I've got my monthly hazard insurance, I've got my monthly property tax, and I've entered my mortgage insurance. Now, for a conventional loan, which this one is, I only need the 78% cutoff. I don't need to calculate the MI every year on the balance like I would for a government loan. And I don't need to specify a minimum number of months for the MI. Now, here's where the reserves come in. There's some new fields down at the bottom here where you can enter exactly how many months of reserves you want to collect for each item. You can also choose whether you want to collect an annual premium. So you can see that I've got 3 months of reserves for my hazard. I'm also collecting an annual premium. And then I've got 2 months of reserves for my taxes. And what that equates to when we go back to our closing cost detail is it pre-fills these line items in here for me. So I no longer have to do the manual calculation behind the prepaid reserves. All right, so my next product is the 10% down, no MI, MCC. So the only thing that's different between this one and the first product is that I have the rate a little bit higher because I'm going to basically use a lender credit to remove the monthly MI. So I've quoted them a higher rate here. And then my closing costs are the same. The difference here is I removed the MI. Now the third product here is 10% down MI, no MCC tax credit. So you can see how using the copy button would really help you generate this presentation quickly. If you use the copy button and then just disable whatever field is the difference, which that's the difference in this case is that MCC tax credit line, I can copy that first product in to this third slot, uncheck the box, and I'm good to go. So I don't need to do anything with my closing costs. I don't need to do anything with the monthly costs or the reserves. And fourth product, same thing. This is a copy of the second product, but without the MCC checkbox. Now let's take a look at what this looks like on the live report. All right, so you can see that the 10% down, no MIs, they're identical in terms of their payment. And so are the 10% down with MIs. The MCC tax credit is not factored into the monthly calculation. It is, however, factored into the tax benefit. So when we look at the lower left corner here, you can see the savings over 60 months. This is generated by taking the total interest in MI paid, subtracting out any tax benefit, and then adding closing costs. Now, since these all have pretty much identical closing costs, the real difference here is going to be the interest and the tax benefit. So let me show you what that looks like. And when we're looking at the savings over 60 months, if you really need to be able to explain this to your borrower, we're really isolating these bottom three lines. So we're starting with the 65,991. That's the interest in MI that they're paying over this 5-year period of time. We are subtracting out the tax benefit. That's 28,282 for this period. And then we're adding the closing costs. And you can see our total costs come out to 42,035 for that first line. And we do the same thing across the board for each one of these to generate a total cost. And then we compare these numbers in the orange bar together to find out what the savings difference is. Now, as you can see here, there's always going to be one of them that's going to show a zero. The 10% down with MI, no MCC credit, is the highest cost. And of course, the reason here is check out our differences, and let me unhighlight everything else, but check out our differences in the tax benefit. Much greater tax benefit when they do have the MCC tax credit versus without it. So what this results in is a lower total cost over time. Now, when we look at the long term, you can see interest in MI paid in 15 years. This does not include the tax benefit. So we're just looking at the interest in MI totals up here. So you see the green lines. We still do show the tax benefit in the detail here, but our total interest in MI is what we're looking at. So we're not including that tax benefit calculation in the long-term section. All right, so that being said, let's move on to the second point. And this is going to be, how do you do construction loans in Edge? So what I've done is I've prepared a presentation called Construction versus Pre-Built. And you can see I use the same strategy that John was talking about earlier, where even if they don't own a home right now, I'm checking own. And then when I get to the goal screen, I'm checking purchase a new home. So it's not going to ask me about current mortgage. I do need to make sure and enter my property value slash purchase price here. And then if I do want to show tax benefit, I can show the tax bracket in here. So I'll do that. I'll put the 28%, but I'm not going to include an MCC credit on either of these. I'm just going to show you what the construction part looks like. Now I can skip this information right here because I'm not getting this straight from a client. I'm actually kind of putting out a marketing report so they can see the difference in what happens if you buy a construction property, where have a year of construction and then start into the mortgage, versus buying a pre-built home where you start on the mortgage in day one. So here's how I put it together. The first one is construction to 30 fixed. Now remember, these are construction to permanent. These are not just the construction period. There wouldn't be a way to compare that against a mortgage. So these are all construction to permanent. Now what this is going to result in is it's going to have a 30-year amortization. You can see I've got my 360 months there. But if you click on the construction button, it's also got a 12-month construction period. Now, when you do these in Edge, it's going to ask you for the length of the construction period and the rate for just that period. And oftentimes it is significantly different from the interest rate they're going to get on the mortgage itself. Now, it may not be this different, but I wanted to show you exactly what it does. Now, that's all you need to do to make this a construction loan. So for my next parts, I mean, it's the same thing in the details. I've got my reserves in there. I've got all my basic figures. I applied it to the loan. And then I put in my monthly costs, and you can see I've got MI on this one. And I'm collecting my premiums, and I've got my reserves over here. Now my second product, the only difference between this one and the first product is that this is a pre-built. So this one is ready to go. It's just a regular mortgage, 10% down at 4.5 for a 30-year term. Now, if we were to click on the construction button, you'll notice that there are no months listed and there is no rate listed, which means this one is not going to have a construction period at all. Now, here's where everything comes into play. Let's take a look at the preview of this presentation. Now, most importantly, you're going to have a new button. Underneath any of the programs that you mark with a construction period, you're going to see that you have a construction button. And if you click on that, it tells you the length of the period, the rate for the period, and the estimated interest. It also disclaims that construction payments may vary based on the draw schedule. So we're not collecting a draw schedule for you. We're doing it just like your LOS does, which means we take that 12 months of interest at this rate and then we divide it in half. And that's what this figure is. Now, when we look at how these are compared down the line, the mortgages themselves are going to have identical payments. So we're going to have an empty graph, which is okay. That's exactly what we should see. But if we look at the short and long-term areas, you notice I've pushed these out to the end of the term. You see the freedom point on the construction mortgage is 31 years versus the pre-built is only 30 years. That's because we have a year-long construction period at the very beginning. Now, when we look at our savings over 373, because I pushed it out past the payoff point for both, you can see that there is a $10,500 difference. That number is it's exactly what the construction period is looking for in terms of just the interest. Now, the difference and the reason it's not showing this 14,625 is because that interest is also tax deductible. So when we look at this, you can see the tax benefit is a little bit higher on the construction loan than it is on the pre-built. And if we're looking at our total costs over time, just like we were talking about earlier, we have interest and MI paid minus the tax benefit plus the closing costs. And that's how we're arriving at our total cost figure. We then compare those two costs together, and the total difference between these two loans when they're fully paid off is $10,530. Now, these are pushed out all the way to the end so I could show you the difference. Now let's go back and we'll select a shorter term area. So for my midterm, I'm going to select, let's say, 72 months. And then for my long term, I'm going to select 15 years. And then we'll jump back over to our presentation. We're going to wait for it to update. And you can see that the construction loan in the early term is actually showing a savings versus the pre-built. So if we look at our more info section now and we add these figures together, the tax benefit is just slightly greater on this construction loan. That's really what's making the difference for us and what's showing a savings, because the interest and MI paid are roughly the same. They're only about $600 apart. So we've got this extra benefit from the construction period that is forcing the total cost to be a little tiny bit less on the 72-month plan. Now, when we look at the 15-year plan, there's a $6,000 difference. You're paying more over the long term because you do have that construction period tacked onto your amortization schedule. But one thing I should tell you is when we're looking at our short term 72 months, remember that this is 1 year of construction and then 5 years of amortized payments for the construction loan. On the mortgage side, this is literally just 6 years of the interest they're paying. They're starting the mortgage right away versus with the construction period, they're holding off for a year before the mortgage starts. So all they're paying in that first year is half of the interest on that construction period. All right, so hopefully that makes sense for everybody. Now, you can do any combination of these. So I showed you them separately where you've got MCC and construction separate, but you can certainly couple them together. You can put these on a rent versus own report, like John was talking about earlier. If they are renting, obviously the tax benefit behind any home versus being a renter is significantly greater. But there's different levels of tax benefit they can get, whether they choose a construction loan or if they choose to buy a pre-built property. So those are just some things to keep in mind on these. Now, when you're talking about different purchase strategies, I've showed you a couple of different options where I kind of mixed MI in there in the beginning for you so you can see what it looks like. I've showed you a construction versus a pre-built. Other options, you can do things like FHA versus conventional. That should be kind of a bread and butter report for you. You should always have that one ready to go. Other ones are varying levels of MI. So you saw that I did a MI versus no MI, but what about maybe a single premium buyout? Um, what about you're financing the MI into the rate versus calling for a single premium at close, or even having the seller cover the single premium so that the borrower is not responsible for monthly MI. So there's lots of permutations you can do with this. And right now, it's still a great purchase market. So the idea behind this is you want to show as much creative financing as you can. It doesn't all have to be on the same presentation. In fact, I like separating them like this because I like having one presentation that I can send to somebody who is considering doing a construction loan. And then I want another one that I can send to somebody who's looking at, different MI options. And yet again, I want another one for a borrower who's told me, I just don't have a whole lot of money for the down payment, so I'm considering an FHA loan. In which case, show them the difference. Show them that conventional. Show them a low down conventional with say a 5%, and the savings over time, obviously, on a conventional versus an FHA are going to be pretty tremendous because of the MI. But the borrower should know about it. That you've got an option here. You can come in with less and do this FHA, but it is going to cost you over time. Now, one thing you'll see here on this, in a matter of fact, let's get off the construction loan for now. I do want to point out one thing before we wrap our call today, and that's we saw briefly what those reserves fields do, but they're also in your settings. So if you want to actually modify your product templates, you can include reserves on your product templates now. So as you can see, I've got an FHA 3.5% down product. There's my down payment. I've got prepaid interest days that come along with it. And when I go into my closing cost details, you can see that I've got just the standard ones that I would normally use, but check this out. My closing cost details on this one actually include all my reserves as well. And the reason they do is because at the very bottom here, you'll see that you can actually tell Edge, I want to collect these reserves here. So when you now pull in a product template, it pulls in the entire thing. So you've got not only the loan details and the monthly costs like it used to have, you've also got the closing cost details that you've entered as well as the reserves. So you have a complete product in one shot now. And generally, the only thing you're going to need to edit when you pull in one of these things is you might have to edit your title fees because they might be different for varying reasons, and you might have to alter your loan origination. That's about it. Two fees to edit versus having to edit, 7 or 8 of them, or maybe even pulling a fee worksheet to try and figure out what your reserves are. Big time saver. So make sure to update your templates to include these reserves here, and I think it's going to do you a lot of good. So with that being said, 20 minutes, I think we're right on the mark here. I don't see any more questions in the box, so I'm going to give just a couple of more minutes to see if you guys have any questions on items that you'd like covered today. We do have 10 minutes left, but I'm all in favor of wrapping early if you guys are done. Just let me know if you have any questions on anything, and I'm going to continue to go through another purchase strategy for you. So I'm actually going to do a rent versus own presentation so you guys can see what it looks like. So this is Joe Renter. And the reason I'm going to do a rent versus own is I do get a lot of questions coming through the support box about what is the standard deduction field? Why would I use it? And why am I showing a tax benefit on the rent side? So let's go through it. I've chosen this person to be a renter. My friendly name is going to be, say, RVO for Joe Renter, something like that. Now, in this case, because I chose rent, I have a different set of goals here. I'm going to choose get my first home. Now, when we get to the rent category, we're going to be asked for their current amount of rent. Let's say they're paying $2,000 and the annual rent increase. Usually, I like to use the same rent increase as I do for the property appreciation. So when I get over to my analysis screen, I'm going to tag the property appreciation for 3%, just like the rent. Now, standard deduction. This is the one that gives people trouble sometimes. You certainly don't have to enter the standard deduction, but I'll tell you, if you do enter the standard deduction, you're going to see a tax benefit on the rent side. Now, the reason we did it this way is we wanted you to be able to show an apples to apples look at what's your real tax situation if you continue renting or if you decide to purchase a home. Now, if you want to find out the standard deduction for your client, you can always hit Find Standard Deduction. And this is going to take you through a few questions. It takes less than 5 minutes. I think I can get through this in about 2.5 minutes. But you're going to answer a few questions. And when you get to the end of it, you'll have a dedicated figure for that standard deduction. So here I'm going to say 6,100 because this is a single filer. Now, very important on the rent side, we need to make sure to input that tax bracket if we want to show tax benefit. Now, specifically, because in the screen before I'm showing a standard deduction, I need to have a multiplier for that. So I need that tax benefit or tax bracket in there. Now, the affordability part, second page, I'm going to go ahead and bypass that one in favor of going straight to a new product. And let's show them two different purchase options. And in this case, I'm just going to show them a purchase power report. So this is what kind of power do you have to purchase? How much can you afford? So let's say the first option will be a 320K, 30 fixed. And what I'm going to do is I'll make this an FHA. So let's pull down a product template. And then I will put my 320K. Now you can see because I pulled down the template, it already caught all the information here. All I had to do was pop in my purchase price. It already caught all my goodies here. And when I get to the final screen, you can see the only thing I need to do here is I need to enter my percentages for my monthlies. And once I do that, it multiplies those against my my reserve multipliers, and it funnels them back over to my prepaid escrows. So a couple easy steps. I've got one product. So now I'm going to add a second product. Now for this one, I'm going to use the copy button. So I'm going to copy that 320, hit OK. Then I'm going to rename this one 330K. And all I'm going to do is change my purchase price. So 330. This is automatically going to update my reserves and my monthly costs that are based on the loan amount. So those ones are a little bit different than on the first product. And you can see when we get a little bit farther in, we have just a slight difference in the net monthly payment as we're going forward. Now, the whole reason behind putting in that standard deduction field on the rent side is if you wanted to show the tax benefit analysis. Over the 5-year period of time, they will have a tax benefit, and this is just from the standard deduction, of $85.40 if they continue to rent. On the home ownership side, they get to write off the interest. So at that point, we're looking at a tax benefit over the 5-year period of time of $24,730. Now, for any of you who would like to actually have the equations behind the tax benefit calculation, we do have that available on our knowledge base, and we also have it in support. So if you'd like to find it, check out help. Just click on help. This is going to take you over to our knowledge base and type in tax benefit. And you can see the first line item here is how is the tax benefit calculated? And this tells you the exact calculation behind it. Now, one thing I will tell you is this includes tax bracket times monthly MI payment. MI is not currently deductible this year, so I would exclude that. Just uncheck the box that says MI is tax deductible on your products. Let me show you where that's at real quick. So if you do have MI in here, you'll see a little checkbox just to the right of it asking if it is deductible. It's not currently, so I would leave that checkbox unchecked. All right, so now that we've got a tax benefit analysis going, we need to choose what we're going to do for the long-term metric. Net worth is actually kind of a good one. As a renter, they have no net worth. If you do decide to put a savings back in the affordability section, so let's say we put in 25 grand and that's growing at a 0.5%. By the time we get to our analysis screen, you can see that the net worth is here for the rent. They have 26,947. That's just their liquid asset growing at that 0.5% over 15 years. But the net worth on the home ownership side, obviously much greater. They're accruing lots of equity in the home, and they actually still have a little bit left in the bank account. Let me show you what this looks like. Pardon me. All right, so you can see on my new mortgage options here, we got a $25,000 current savings account. The cash to close on each one is slightly different, 17.7 versus 18.1, which means we have a varying degree of a new savings balance after close. That's what these figures are for under the savings start line. Those are going to continue to grow at a 0.5%, and you can see that they'll have $7,800 on the 320 loan. They'll have $7,300 on the 330 loan. But remember what we saw for their long-term net worth. 313,000. This is all the equity they've been accruing. The net worth on the home ownership side is liquid assets plus the equity. So just be prepared to explain that to your client. I am going to show you a preview of this presentation because there's one more thing that I do want to draw your attention to, and that is the net monthly payment. Get a lot of question about what is the net monthly payment on a rent versus own. Now you can see what our total payments are here. These are the pity payments and obviously the rent payment here on the rent side. Now the way we get to our net monthly payment down at the bottom here is we start with our pity payment, or our rent payment in this case. We subtract out the tax benefit, and that gives us our net monthly payment. Same thing on the home ownership side. We start with the pity payment. We're subtracting out the tax benefit. We're also subtracting out the principal paid. They're retaining that in the form of equity, so we're not considering that a cost. That results in this 1182 figure. Same thing on the 330K loan. We arrive at 1219. So when you're asked, what are these payments? These are the unrecoverable parts of the payments. They're retaining that equity. They're retaining the principal in the form of equity. They're getting a tax benefit on this. So those are not costs. We remove them from the pity payment to show these net monthly payments. But do keep in mind, we still do show you the full pity up here in the total payment line. All right, so with that said, it looks like we have only 1 minute left. I don't see any more questions in the box, so I'm going to go ahead and wrap for today. Everybody have a wonderful day. If you have any questions about either of these strategies, feel free to shoot us a note over at support@mortgagecoach.com. We're always happy to help. If you include a link to your presentation, that's very helpful for us as well. We can go in the back and take a look at your data entry and just make sure that everything is the way it's supposed to be done. But with that said, have a wonderful day, and I look forward to seeing you next week on our next 16 success strategies. Thank you very much. Take care.